Everyone is waiting for the Fed to fix the economy, cut rates, make borrowing cheaper, save us. But here's what nobody is telling you. The Fed is trapped. And understanding why changes how you see everything. When the Fed changes interest rates, it affects everything in your life. Your mortgage payment, your job security, the price of groceries, gas, rent, everything. So when the economy looks shaky, everyone expects the Fed to step in and fix it, cut rates, make borrowing cheaper, boost the economy. But they can't. And understanding why matters more than you think. The Fed has two jobs: keep inflation low and keep employment high. In normal times, these two goals work together. When the economy is strong, people have jobs and prices stay stable. When the economy weakens, the Fed cuts rates to boost hiring without triggering inflation. But we're not in normal times. Right now, inflation is still elevated. The official number is 3.3%. But anyone buying groceries knows it feels higher. Housing costs are up, energy is up, insurance is up. At the same time, the job market is weakening. The last jobs report said America added 178,000 jobs, but the labor force participation rate is at 61.9%, the lowest in 2 years. So here's the trap. If the Fed cuts rates to help employment, they risk making inflation worse. Cheaper borrowing means more spending. More spending means higher prices. And higher prices hurt the exact people they're trying to help. But if they keep rates high to fight inflation, they risk pushing the economy into a recession. Higher rates mean expensive mortgages, expensive car loans, expensive business loans. Companies stop hiring. Some start laying off. And this isn't abstract. This is hitting real people right now. At the peak in 2023, mortgage rates hit nearly 8%. Today, they're around 6.3%. That's still more than double what people locked in during 2021 when rates were near 3%. On a $400,000 home, that's over $800 more every single month. Money that could go to savings, could go to your kids, just gone. Car loans are the same story. A 5-year loan on a $40,000 car at 7% costs you about $4,500 more in interest than the same loan at 3%. That's half a year's worth of groceries for a family of 4. And if you're a small business owner trying to expand, forget it. A $100,000 business loan at 7% costs $7,000 a year just in interest. At 3%, it was $3,000. That's the difference between hiring someone or not. So when people say the Fed should just cut rates to help the economy, they're not wrong. High rates are crushing people. But cutting rates makes inflation worse, and inflation is also crushing people. The Fed can't fix both problems at once. They have to choose. And right now, every choice makes something worse. That's not incompetence. That's the dual mandate trap. Subscribe, like, and hit the bell so you never miss an explanation. But it gets worse, because most of the forces pushing prices up right now are things the Fed can't control. Tariffs have been layered into almost every major supply chain. That makes imports more expensive. And the Fed can't do anything about it. Interest rates don't change tariff policy. Then there's geopolitical instability in the Middle East, putting pressure on oil prices. And everything downstream from oil is getting more expensive. Shipping, energy, food, fertilizer, plastic, even the packaging your groceries come in. The market has priced in a short spike. But if instability continues, oil stays expensive, and that means inflation stays elevated. Cutting interest rates into a tariff and energy-driven inflation shock is like pouring gasoline on a fire. It doesn't put it out, it makes it worse. So even if the Fed wanted to cut rates to help the job market, they'd be cutting into supply-side inflation they have no control over. And that would make the problem worse, not better. This is why central bankers call this environment a nightmare. They're being asked to fix problems they didn't create and can't solve. But there's a third problem, and it's the one nobody at the Fed wants to say out loud. Right now, there's still a lot of faith in the US dollar as the global reserve currency. But that faith is not infinite, and there are already signs it's cracking. If the Fed cuts rates in spite of visible inflation, it risks accelerating a shift away from the dollar, and that creates a feedback loop. A weaker dollar makes imports more expensive, which makes domestic inflation worse, which makes the dollar weaker, and so on. But it also affects borrowing costs, and this is where it gets personal. When the government borrows money, it sells Treasury bonds. These are basically IOUs. The government promises to pay you back with interest, and the interest rate on those bonds is called the Treasury rate. Now, here's why you should care. Almost every loan in America is priced off Treasury rates. Your mortgage, your car loan, your student loan, small business loans, corporate debt, all of them. Banks look at the Treasury rate. The government pays around 4% to borrow money. They charge you 7%. That 3% difference is their profit and their risk premium. So when Treasury rates go up, every other interest rate goes up too. Your mortgage gets more expensive. Your car loan gets more expensive. Everything costs more. And here's the nightmare scenario. The Fed cuts short-term rates to help the economy, but long-term Treasury rates go up anyway because bond investors are scared. They're worried about inflation. They're worried about the dollar. So they demand higher interest rates to compensate for the risk. So borrowing gets more expensive, even though the Fed is trying to make it cheaper. And this isn't speculation. It's already happening. The cost of borrowing through the 10-year Treasury has been climbing. That's tens of billions of dollars in additional interest payments for the government, and it trickles down to you. So if the Fed cuts rates and investors lose faith, rate cuts could, ironically, make borrowing more expensive, not less. That's the dollar reserve problem, and it's the biggest constraint the Fed faces right now. So why is the Fed in this trap? It's not because they're corrupt or stupid or controlled by some shadowy group. It's because the system was designed for a different kind of crisis. The dual mandate works when inflation and unemployment move in opposite directions, when you can fix one without breaking the other. But right now, they're moving together. Inflation is still elevated, and the job market is weakening. That's called stagflation, and the Fed's tools weren't built for it. Add in supply-side shocks they can't control, add in the risk to the dollar's reserve status, and you get a situation where every move makes something worse. The Fed isn't failing, the system is. And this matters right now because the pressure to cut rates is enormous. The White House wants lower rates. Investors want lower rates. The stock market wants lower rates. But cutting rates into this environment could trigger the exact crisis everyone is trying to avoid: higher inflation, a weaker dollar, higher long-term borrowing costs, a recession anyway. So the Fed is stuck, and understanding that they're stuck helps you understand why the economy feels broken even though the stock market keeps going up. The Federal Reserve can't save you. Not because they don't want to, but because the system they operate in has trapped them between impossible choices: inflation or unemployment, short-term relief or long-term stability, domestic growth or global confidence in the dollar. They can't fix all of it, and pretending they can just sets everyone up for disappointment. That's how it actually works. If you want to understand how we got here, watch this next, and subscribe so you don't miss the next one.